Okay, the next thing to consider is what kind of a business are you running? And I break this down into four different types. I call them the solopreneur, the lifestyle business, the growth business, and the large business. So the solopreneur is what many companies are around the world, where it's one person, and they might have a little bit of outsourced admin and accounting and other bits and pieces, but basically it's one person doing their thing, going out into the world and making their difference, but it's just them. If you're a solopreneur, great, all the very best to you, but it's very difficult for solopreneurs to secure any kind of funding other than debt, where they would then probably have to provide a guarantee on that debt so that if it goes bad, their personal assets are at stake. In terms of equity funding, in terms of raising money from external investors, as a solopreneur, very difficult, because all of the risk is on you. And it's just a really challenging thing. And from an investor's perspective, there's a lack of security, and they're going to be very concerned about that. So if you're a solopreneur and you want to go out and raise funding, you need to build a small team around you so that there's more than just you in the business. If you're a solopreneur and it's going well, fantastic, keep going, but you won't secure equity funding. Then there's the lifestyle business, and these are often very successful businesses, but they are designed around a particular lifestyle that the founder wants to have, or maybe there's 2 or 3 founders in the team, and they're very happy and they can make a lot of money, and they can be very successful as companies. But what they find is they're running the company to support their lifestyle. They're not running the company to grow it. They're not running the company to make significant changes in it. They're running the company to support their lifestyle. It's generating the kind of money they want. It's generating the kind of time they want for their freedom, etc. So that's, again, a very difficult area if you're seeking funding, because investors aren't going to want to come in and fund somebody else's lifestyle. Which takes us on to growth businesses. And this is where investors are absolutely interested, because they are looking at, what can I do to put my money, my expertise, my networks, my contacts in to support this company to grow it over time, so that in 3, 5, 7, 10 years, there's a significant payback, there's a significant return on my investment. And it's those growth companies that are really the sweet spot for venture capital, angel, investment type of funding. So if you are looking to achieve a situation where you've got funding coming in, you need to be having in your mind very clear that you are a growth company. And finally, there are large companies, and these are often companies that have been set up by entrepreneurs one day, and they've moved on, and perhaps it might not have passed on to the next generation or whatever, and external management has come in. And most of the large companies that we see in the world around us today, were started by founders, but grew to a point where the founder eventually exited the business and a professional management team came in. The professional management team often don't have more than 1 or 2% of the equity, because most of the equity is funded through external investment. So obviously those kinds of companies also have access to significant pools of capital from private equity or even from public markets for those who go on and do an IPO. But in terms of going after funding for entrepreneurial businesses, your sweet spot is growth, because your investors are looking for a return. So you need to be a growth business. You need to be not looking at an equity hoarder. You need to be not looking at being a frugal leader, but being a growth business with a growth mindset, and you're bringing in the capital to achieve what you want to do with your business.